For most of us, the mortgage on our home is our largest monthly expense, which is why in today's video, I want to share with you a couple techniques that you can use to pay off your mortgage years earlier and save tens of thousands of dollars, if not hundreds of thousands of dollars in interest payments. Let's go for a walk and talk about this. I've been a financial advisor now for over 20 years, and I've helped my clients think about how to pay off their mortgage earlier and to save this money and to gain the financial freedom that comes from being mortgage free. I want you to have that as well. So let's talk about the techniques. Now, oftentimes a discussion like this is fairly complex. It involves an Excel spreadsheet. I don't want to do that to you. I'm going to give you a free online resource that you can use yourself, and you can run all of these calculations. You can input various scenarios that make sense for you and your family and come up with the game plan that's best for you. Stay to the end and I'll share with the free resources that I use for today's example. And in the example, I assume that you have a $500,000 home. You put down 20% on that home, so you have a mortgage of $400,000. And unfortunately, in today's interest rate environment, a fixed 30-year mortgage, the interest rate on that is 7%. So that's what I put in for this calculation. So at 7% over 30 years, you're going to pay over $560,000 in interest alone on that $400,000 loan. That's a lot of money, right? I mean, you're paying more in interest than you did for the total value of the loan. And so how do we get around this? How do we pay that off early? Well, there's unfortunately, there's a fair amount of misinformation on the internet. There's techniques called velocity banking. I'm not a fan of that. I don't believe in that. Really, the ugly truth is there's only two ways to pay off your mortgage early. Well, really three ways. That you can make additional monthly payments, you can make one-time payments or annual payments, or you can refinance if we're lucky enough and interest rates go down. So those are the three techniques that we have, and I'm going to go over two of those, which is paying off, making extra payments either on a monthly basis or on a yearly basis. And the refinancing, that'll be a video for a future date that hopefully I get to do soon when interest rates start going down. But you know, obviously if interest rates start going down and you can get your loan refinanced at a lower interest rate at very low cost to you, then that probably makes sense to look into doing. But until that day comes, let's go with what we know we can do today. So if we take out a $400,000 loan, again, the interest payments are going to be $560,000 over the 30-year term, and we're going to pay that loan off finally, as I record this, in 2054. So what if we start making some extra payments? What if instead of just making the payment on our mortgage, we pay an extra $125 a month? If we can do $125 a month, we're going to save over $100,000 in interest payments, and we're going to pay off that loan 4 years earlier. So instead of 30 years, it's going to be 26 years. Now, if we can pay $250 extra a month, then we're going to save $150,000 and we're going to pay off that loan 7 years early. And if we can pay $500 extra a month, which I know is hard, but I want you to see what kind of the spectrum is. Again, remember at the end of the video, I'm going to share the resource that you can plug in your own numbers. But if you can pay that extra $500 a month, you're going to save $230,000 off of that loan, and you're going to pay it off 11 years early. Okay, so that's one option, but a lot of people might say, you know what, I know myself, I'm not going to do those extra monthly payments. It seems at the end of the month, I don't have extra money for investing into the mortgage. Azul, what could I do if I just did a one-time lump sum? What would that look like on my mortgage? So let's say that halfway through your 30-year mortgage, you've been saving up money, you've got some money in the bank, you've got some money in your IRA, some money in your 401ks, and you say, you know what, I want to take some of that money. I want to carve out some of that money. And for the sake of argument here, I said $50,000, 50. What if 15 years from now, you could put in an extra $50,000? So you're saving an extra $3,000 a year for 15 years. That, even if it's a relatively low interest rate, over 15 years, that should give you $50,000. The nice thing about this option is it makes it a tomorrow decision. You can save up this money in the bank. It's liquid. You can use it as your emergency fund when you're younger and there's not a lot of cash available. It can be dry powder for you. It can be in case you find a rental property investment opportunity. It could go towards your down payment. So while you're saving this money up, it's in a bank account, it's liquid, you have it available to you if there's other investment opportunities that come along. But let's say we get 15 years in and we say, you know what, really, Azul, what I want to do is I want to pay down that mortgage. What would happen if you put that $50,000, just a one-time extra payment? That's going to save you, believe it or not, $265,000 of interest, and it's going to allow you to pay off your loan 11 years earlier. Now, many folks, when we get a mortgage, we'd really like to qualify for that 15-year mortgage. It tends to have a lower interest rate, and boy, the idea of paying off your mortgage in 15 years instead of 30 years is really attractive. And often, like if we get a chance, if interest rates come back down, you may find yourself in a situation where you can refinance instead of into a new 30-year loan. Let's say you're 5 years into your current mortgage and you refinance. Well, if you're 5 years in, that means you have 25 years left, and then you'd be mortgage free. But if you refinance at the lower interest rates, now you've got another 30 years until you're going to pay off that mortgage. So when you refinance, it's definitely worthwhile looking at a 15-year mortgage. Could you keep your monthly payment the same? But instead of paying it off, in this case, I said you're 5 years in, instead of paying it off in 25 years, now you could pay it off in 15 years. So that's one thing to look at doing. And the other thing is this one-time payment that I'm talking about. It's going to take 11 years off of your 30-year mortgage. So that converts it from a 30-year mortgage to a 19-year mortgage. So it's a really powerful thing, not just to save money, but also to get you mortgage-free where you don't have to make a mortgage payment as soon as possible. Okay, so there's all kinds of different alternatives that you can run. You can look at your mortgage situation. You can pay off, my first example was $125 a month, and that saves $100,000 over the life of the loan if you do that every month. $250 a month is going to save you $150,000 over the life of the loan. You're going to pay off your 30-year mortgage in 23 years instead of 30 years. You can also, the other example I ran is an extra $500 a month, an extra $6,000 a year, and that's going to save you almost $250,000 in interest rate and 11 years, which brings your mortgage term down from 30 years to 19 years. And you can run all of these scenarios for yourself. There's many free online mortgage calculators. So it's a really nice exercise to go through an Excel spreadsheet and do this yourself. But it can get pretty complicated, and I want the numbers to be right for you. And so the site that I used was bankrate.com. You can run these numbers yourself, and then I encourage you to do it. Now, know that on bankrate.com, so if you just Google bankrate.com free mortgage calculator, you'll find the same tool or a similar tool to what I use. Know that they include property tax, so they're going to ask you for the zip code of the home, and then they're also going to include homeowners insurance, because if we have a mortgage, the bank is going to require us to have a loan. I put both of those at 0 because I just wanted to see what the impact on the loan itself is. But you do you put in the numbers that you want. So one of the great feelings in life is being mortgage free. I'm fortunate. I'm now in that situation. After 40 years of working, I'm in that situation. I want you to be mortgage free if that's important to you. Now, if your mortgage rate is pretty low, financially it might not make sense to pay off your mortgage early, but there's the academic answer, and then there's also the emotional answer. The answer that's right for you based on the value that you place on not having the responsibilities and the burden and the stress that is on our shoulders when we have a mortgage to pay. So even if you are fortunate and you have a 3, a 4, maybe even a 5% mortgage rate, does the numbers make sense to pay that off early? At 3%, I can tell you for most people, the academic answer is no. But again, the emotional answer, what's right for you? Does it keep you up at night? Is it a goal to be mortgage free? If it is, then it makes sense to look into that. And I encourage you to work with a financial advisor or an accountant that's a fiduciary to you to help you make the right decision for you. You do want whoever you're working with to know who you are and what's important to you, because you don't want just the academic answer. You want somebody to have a conversation and help you, if you're married, you and your spouse come up with the answer that's right for the two of you. And just like it feels great to be mortgage free, it also feels great in order to be able to retire early and to take full advantage of the youth of your senior years. Unfortunately, by the time we're 60 years old, most of us are going to have less than 1,000 weeks of healthy, active time in front of us. And I want to see you take full advantage of each and every one of those weeks, which is why I made this video here, 5 reasons to retire as soon as you can. I'll see you in that video, and thanks for watching this one. Bye-bye.